Like, look at the financial crisis, which was fundamentally caused by these collateralized debt obligations. And people really didn't know in the banking system what their exposures were, because they'd written so many of these things. In fact, they did them so fast, they didn't have any documentation around them. So if someone left your team on a trading floor, some company could come back 6 months later and say, oh, you have this huge collateralized debt obligation with us. And everyone would be like, we do? Did we do that deal? Do we even have a record of it? And so if private sector can't even keep track of what's going on, certainly Washington can't keep track.
Yes, and that's the issue, right? Is that who watches The Watchmen? Well, currently the people that watch The Watchmen don't even know that The Watchmen can't watch themselves. And that's the
okay. That is like a clip we have to catch. The Watchmen, the Watchmen, the Watchmen. Which Watchmen?
Which Watchmen? Which
we
Watchmen?
don't know which one. Where's the Watchmen?
I'm having so much fun right now. This is, once again, Dr. Pippa Malmgren. Eugene is the one that's saying in the live chat, there's a new generation on the block. This movement is huge, and I believe the banks and government don't fully realize the force we have become. Don't let them short that like button, ladies and gentlemen. That helps get Pippa's message out to everyone. Dr. Malmgren is here generating and donating our time and education for you guys. So thank you to her. And if you guys can smash that like button to get over 1,000, that's going to be able to help other Moon Platoon members get this message out. We almost covered some NFTs conversation. If you want to pivot there, or we can continue striking down the GME situation, because we still have some DTCC regulations. One passing last week and the week before, and coming up soon. That is likely going to change the entire situation.
Yeah, actually, and I have been following the details on that as closely as you guys have. I'm not actually trading, just for the record, in any of this. So if you want to go into that for your viewers, like, what do you think is the impact of that?
I've been calling that the mother of all short squeeze catalysts, right? We are looking for catalysts because at the end of the day, we can be trading between resistances and supports. We could be, getting a couple of sick impulse waves and then slamming down on a couple of corrective waves. At the end of the day, we can't break out of the let's say the funnel, right? The wall that the shorts have put us in without some strong catalysts. The reason why the DTCC, NSCC 801 is the catalyst for everyone to look at is that it incentivizes the hedge funds to eat each other. If you guys haven't caught up with this fact yet, it's the idea that DTCC has put out that everyone should be reporting on a daily basis, or at the very least, we can show up to your doorstep an hour before market opens on a daily basis and say, what kind of risky business are you trying to do, right? What kind of risky business are you putting us at risk for? Because the DTCC can be thought of as the purse string holders for the purse string holders. In that sense, when the hedge funds have an unsatisfactory answer, or if they lie to the DTCC, they are saying none of that is going to be our liability anymore. We're going to take our $1 trillion insurance package and get out of here because we're not going to cover you. If you guys have been wondering who's going to pay for the AMC and GME squeeze, it's going to be those hedge funds first, then their clearing firms, and likely the DTCC is going to be an extension of that, and then ultimately possibly the US government. I'd love to hear what Dr. Malmgren has to say about that. But the 801 rule is an incentive for everyone to snitch on each other. Because if one of you defaults, depending on how much actual bad stuff you did, you are going to be responsible. But then all of your friends, even the innocent ones, might be responsible for holding the margin call that is going to make you trigger more margin calls down the future. That's the mixed squeeze that I talked about on the channel a couple of days ago. A margin call squeeze, after one of these hedge funds gets in trouble, they might all get in trouble. And that is an incentive system that makes it possible for them to eat each other alive. Is that enough context?
Yeah, well, and the other thing is, the conditions right now where stock markets are high and typically, leaning in an upward direction is very different when things start falling apart. And so you can withstand some pretty bad news while stock markets are so elevated. And my personal view is they're going to remain elevated. In fact, they're going to go higher. And I think I'm very bullish on equities just from a macro point of view. Like I said, we got a record amount of capital. It's looking for a home. I personally think that we've got the supply chain broken at both ends, the supply and the demand end, the US and the China end. And so that typically makes prices rise. So I think we're going to see inflation increasing just a little bit. And when you go from 1% to 2%, everybody goes, oh, well, that's no big deal. But it's a huge change if you are a pension fund in your asset allocation, and you're definitely moving into equities because you've got to outrun inflation. And if you're a poor family, 1% increase, 1% percentage point jump in inflation is huge. So it raises the risks of social pressures enormously. So I think for all these reasons, we actually are going to see the stock market support it. And what you're talking about might be exposed more quickly if we had a serious fall in the markets, which is what most economists are anticipating, right? Most economists think that sooner or later we're going to have a stock market crash. But I think quite the opposite. And as we come out of COVID, I think the recovery is going to happen faster and more sharply than people expect as well. And that also will support stock markets, partly because we're starting from such a low base of economic activity. Like if somebody just sneezes and GDP is going to go up 20%, like not much has to happen to create some huge jumps in the GDP numbers, and then everybody feels more confident, and suddenly stock market goes up, reflecting all this money, some of which is your audience.
We are in a decade and a half long, maybe even longer bull run. And I was asked by, quick plug, if you guys haven't yet commented on that video that says the Netflix documentary is coming about this GME saga, and you guys want to throw your directorial comments in the hat, I'm going to ask Dr. Malmgren about what she would want to see in the documentary in just a second. But first question is, that producer asked me, hey, we are on this huge bull run. Are we expecting that to reverse anytime soon? I had my opinion, but what do you think?
Okay, stock markets, like all other financial prices, are supposed to go up and down, right? So we should expect volatility. And the longer you don't have it, the more you think it's hiding or repressed, usually the bigger it's growing. So I think we're building up a lot of volatility in the system. But having said that, I think the way markets work is the majority view is usually wrong. So, when most people are anticipating that it's going to fall, it just keeps going up, which is what's happened in the last couple of years, right? Because everybody's like, it can't go any higher. This is ridiculous. Everything's overvalued. It can't go up any higher. And then it goes up and it goes up. And I think the big institutional investors, they've all been behind the curve on this. They didn't make money from the stock markets rising because they were sure that it wouldn't happen. And so for all those reasons, I think actually it's usually the most surprising thing that actually happens, not the most expected thing. So I could see it's also a bit like the volume change matters. So I remember there was a book many years ago that came out called Dow 10,000. And people were like, oh, the Dow will never go to 10,000. I mean, it was at the time, it was like at 4,000. It had never been above it. So the idea that it could go to 10,000 was shocking. Today we're like laughing. So that's the thing. When you throw that much money in the system, has to be a new number. So it might be overvalued to the past, but it's not overvalued compared to how much money is available for investments in equities.
Excuse me. I think that at the end of the day, if the economy is going to have another '08 crisis, it's a blip on the way for the market overall. Look at it back in the 1920s, right? That lasted for a decade of a Great Depression. However, it still is a blip in the grander scheme of things for the market going up. So in that sense, that is the answer that I gave that producer, which is you might see a pullback, you might see a major correction, but it's not going to be similar to a market seeing itself in the mirror and thinking, God, I've gotten fat, or God, I've gotten bloated. It's going to be something that is much more tied to a catalyst like AMC and GME. We've talked about how hedge funds have all of their thumbs in a bunch of pies, like your grandparents' retirement funds, your parents' retirement funds. In that sense, hey, if they have to pull out all of their positions in order to cover for the short squeeze, that is likely going to cause a rippling margin call after margin call, market crash after market crash. What do you think about that?
So again, I think we have been through so much trauma in the last 20 years. You really have to hit this market very hard to create a serious reaction. Like, we've already been through the financial crisis. Now we've been through the COVID. The resilience level is very, very high. And people have already experienced what it is to lose pretty much everything overnight a couple of times in different formats. So I would say our resilience level is a lot higher. The second thing is, it's not going to be like the 1930s again for several very big reasons. Number one, the government and public tolerance for that much pain is much lower. Second, we have all this data now. We can see who those people are that have lost their foothold on the world economy and are now in trouble. And government policies are designed to help them. Now, you can say they aren't doing enough, they should do more, but it's not like the 1930s when there was nothing to help you. If you lost your job, you were toast. And that gave rise to that whole generation. You know, we now use the word hobo to mean someone who's homeless. It came from that era because they genuinely had no roof over their head. This is not the situation today. I mean, even look at COVID. Governments everywhere said you can't evict someone, right? If they can't pay their rent, you can't evict them. So that makes it profoundly different from the 1930s. And I really don't think we're going to repeat that situation. Government policy is also much more agile, adept. And look, the policymakers today are the polar opposite, right? Janet Yellen and, all the key people at the Fed, they all take the view that we would not take away liquidity from the economy while it's down. In fact, the problem today is that you have to be not only back and fit and fighting before they'll raise interest rates, they have to be certain that every single person in the whole economy has a job before they'll raise interest rates, which is what's raising the risk of inflation a little bit for many investors. So and they're not going to raise interest rates until the market begs them for the rate hike. And even then they'll just do a little one and then they'll wait a long time. And so you can be sure that once the rate hikes start, they're actually confirming the recovery. They're not derailing the recovery. They're confirming, because they won't raise rates until the economy is strong enough to take some rate hikes. So I expect the stock market to rise when rate hikes begin.